Global debt is about 370 trillion today. And to that, we have to add unfunded liabilities and derivatives, which I estimate to be around $2.5 quadrillion. So we're talking about total debt of probably around $3 quadrillion, which of course can never, ever be repaid. Excessive debts have brought every single currency system down throughout history without fail. So this is now what is happening to this currency system, which has lasted a bit over 100 years. And we are now, as I've said many times, coming to the end of another monetary era. Debt is being issued at a quicker pace than ever before. Now, we had another bond issue recently by Alphabet, which is, of course, the parent company of Google. And this was a £1 billion bond issue. And not just a 1 billion, but it was a 100-year bond issue, 100 years. In 100 years, no money ever survives. It goes down by probably 90 to 99, even 100%. And we know that if you go back 100 years now to the 1920s, then the currencies in the world, dollars, D-mark, euros, yen, etc., have all been debased by at least 99%. We actually only have to go back 50 years, and since 1971, and since that time, they're also debased by 99%. So we know we're coming to the end of monetary era, but clearly wealth managers and asset managers are not aware of what happens to money over a longer period. This Alphabet issue was 10 times oversubscribed. 10 times oversubscribed for something that we know within 100 years will be absolutely worthless, because so far in history, any money over 100 years has become worthless. Still, people buy these 100-year issues because they think that the short-term yield is good. Now, that doesn't matter if the money is debased by 99 to 100% within a 100-year period. So the pensioners or the investors who receive these bonds in their portfolios will know, maybe, if it's, of course, the people who buy them today won't probably live in 100 years' time, but anybody who takes over these bonds will know that they would be worthless within that period. And what is interesting is that in the next 5 years, especially these AI companies like Alphabet or Google, Oracle, Microsoft, etc., they are estimated to issue debt of around $3 trillion in the next 5 years. Who is going to repay that? Probably nobody. They will probably, a lot of them, end worthless, for the simple reason that, first of all, it is unlikely that these technology companies will actually survive for 100 years. Technology moves so fast, and it's probably going to move from the west to the east. China is advancing by massive steps in this area and will probably be the dominant country within the next 100 years. In 2017, Austria issued a 100-year bond, and I wrote about it at the time. That bond is now standing at a 42% discount. So it's already lost 42% of its value, and that is after 9 years. So we can imagine in the next 91 years, it will lose all of its value, as all of these bonds. I always said to investors, don't ever buy bonds, especially not government bonds or long-term bonds. Governments are never going to repay their debts, and that's why it's the worst investment ever in history. Morgan Stanley recommended recently that instead of the normal asset allocation of 60% stocks, 40% bonds, to have 60% stocks, 20% bonds, and 20% gold. I would recommend 0% in bonds, and I would also recommend having the majority in gold and in commodities in the next 30, 50 years, because we are seeing a massive shift from paper assets to real assets. I showed it in the previous video I recorded, where gold has turned up from a bottom position against the S&P index, which means that we are now going to face a long-term trend change of gold and commodities in general gaining massively against all paper assets. The gold price and the silver price have gone up almost exponentially in the last 2-3 years. Gold, for example, is up about 155% since January 2025. Now, that's just the beginning. And of course, we have seen recently a major correction. It went a little bit too fast, especially silver corrected more, which it always does. It moves faster in both directions. But Investors should be absolutely clear that this change from paper assets to real assets is taking place and is going to accelerate in the next few years. So the correction we saw, for example, in gold and especially silver is just temporary. And that is an opportunity for any investor to increase their positions or now to buy gold and silver if they don't own any, because we are within maximum 2 months, it may be shorter, it could be within a month or less, going to see the end of this correction down in gold and silver, and next phase will be, in my view, could be explosive. We're going to see a move that will shock the world in gold and in silver especially. So prepare for that now. Don't wait for the market to move up, because now is the time to, as I said, add or to enter a position. Looking at what the world is doing relative to the increase in the gold price, ETF investors in gold are certainly not keeping up with the increase in the gold price, which means that the percentage of gold to assets, all financial assets, is probably still not more than 0.5% that it has been for the last few years. Only 0.5% of world financial assets are still in gold. That's going to change dramatically. I would think that it would probably go to 10 times to 5%, which has been a historical figure which we've seen many times. So this is the potential we're looking at for gold and for silver. Therefore, do not be scared by a small correction in a very long-term uptrend. In the next few years, wealth preservation is all about holding real assets, gold, silver, commodities, and getting out of the paper assets. That's the only way you're going to survive this massive change in asset allocation that the world is going to experience in the next few years. If you're left behind, if you stick to your paper assets, if you stick to your stocks and bonds, property, etc., property is not a paper asset, but it's an inflated asset, then you're going to lose a major part of your fortune. And that's not really what investments are all about. So please, go away from the conventional assets, look at the real assets, buy gold and silver in physical form, and of course, store it safely outside the banking system.